Welcome to the Real Estate Show on KMED. This weekend, Pete Belcastro and Joe Brett, the real estate guys, with you this weekend. We're both real estate brokers with John L. Scott in Southern Oregon, and we get together with you once a week here on KMED to talk about all sorts of real estate-related issues and topics. And, well, we continue that great tradition, I suppose, almost 9 years worth and 400-plus shows. And Joe and I, we're just getting better, you think, instead of older? I don't know. What do you say, older but better?
You hope for a little of both. As you get one, you get a little experience. But I will say 9 years, don't miss any shows, because I don't know if we have another 9 in us.
Yeah, we became brokers in 2007. Yeah. And so here we are in 2018. Wow, time days go slow, years fly by. Yeah. So that's a great line really I heard from somebody the other day.
By 2027, we want to be
done. We retired or whatever. Today here on the Real Estate Show, Guy Giles, who's our resident mortgage expert from Bank 34 Mortgages, joined us. And it's always great to have Guy come in and visit with us and talk mortgage interest rates and what goes on in that part of the transaction. Because, it takes teamwork to get a transaction done. And the lender, in about 75% of all transactions, is the person who makes or breaks it, right? Isn't that the way? You're the one, right?
I guess I'm going to call it Freddie and Fannie, either make or break it. I just kind of facilitate. It's really all about their rules about 90% of the time. But yeah, we do get the thing done, and it's just about structuring the thing properly up front. I was actually fixed one yesterday for a guy that got into trouble at a credit union. They just didn't have a program, so he flopped him over to me, and we got him approved, and hopefully got the offer accepted. Myers team.
The one thing I've learned about lending from Guy over the years is that a lender like Guy, which is like Bank 34, and there are lenders out there, they pick and choose from a variety of different loans, products. Yeah. There's a lot of them out there. Whereas the bank, if you go to a big bank, like a Wells Fargo or somebody like that, they only tell you what they have, right? I mean, they just give you their narrow version of that, of their lenders, right? Isn't that right?
And to be fair, that does fit into a large portion of what we do right now. I think the biggest thing is with those guys is they don't have the ability to shop around. Like you said, if one little thing kind of goes sideways, I have 14 other lenders that I can look at to hopefully make something kind of fit into a bucket. But these guys will, the big guys sometimes will advertise some really good rates, and then they'll get so backed up with their pipeline that they can't close them on time, and then they'll have to artificially raise their rates up, and you just hope you catch them on one of their dips. But we have the ability all the time to look around. So it might be that you have a 750 FICO score and a good down payment. Well, one of our investors, and it could be a Wells or something, because I can sell their products, they really like a good FICO score and a decent down payment. So they actually might have a little bit better pricing. And if you're stuck to just one place that does all of their own servicing, all of their own stuff, you're just stuck to whatever thing they like. And if you happen to have a lower credit score, another bank
there's a different bank out there that would take that one.
Yeah, and they both might take it, but one of them might not have pricing hits as hard for you, they might just have incentives for a certain thing. And I found sometimes AFR is the best one if your credit's not the best or it's a manufactured house. So we have the ability to put them all into our engine, and it'll tell us who's got the best pricing. And obviously we don't want to, we'll stick them with a good servicer or a good person that'll do it.
And the big difference is, and this is nothing against, this is just the business models that we're dealing with at those big banks. This is just, the mortgage is just one facet of their lending and services. At Bank 34, all Guy does is try to get you the loan that's going to be the best rate and the best match for you and get you where you need to go.
Yeah, and to be fair, again, I am a bank, but we don't have any deposits here in Oregon at all. Right. So it's just, that's all we do is we strictly lend.
You are Bank 34.
Yeah, around here, yes.
Yeah, but you do a lot of loans. Tell me what your business has been like. We talked about what it was like the first 2 months of 2018 versus a year ago, and how much more it seemed to be busier. There were more lock boxes open. There were more sales during these 2 months than before. What about your end of this?
Well, I had a weird month and a half where it was a whole bunch of refinances, which is something that's just, old clients called me and wanted to refinance. A lot of people have equity in their house right now.
Yes, they do.
So, even, I don't know, even something that may not have made sense a few years ago, might right now. And so I'm looking at these things. I've put a couple people in some adjustable rate mortgages lately, just because they're they're going to sell their house in California within 2 to 3 years, put them in something safe like a 10-year ARM or even a 7 if they're going to retire sooner than that, and we can get them in at a nice low rate. And
have people talked to you, Guy, about the tax cut bill, the law that went into effect in January, about, because it affects housing, in terms of what you can deduct, that $10,000 limit on things like that. Do people ask anything about that, or is it just kind of already kind of gone and we're not, it's there and we're not thinking about it too much?
Yeah, I think it's one of those things that for one, it hasn't really impacted everybody directly yet.
Right.
So, around here usually our taxes aren't that high, so it's it hasn't been as big of a factor. I think the biggest thing that I'm dealing with is that even beyond paying a little bit more to be being down there, they just want out. They're spending a ton on taxes. They can't drive anywhere in less than 5 or 6 hours. So it's a quality of life thing, and I think taxes and all that, they're important, but they're kind of secondary toward just people trying to get in a better lifestyle. And even if it's somebody here, if they have houses on their mind, yeah, it's a factor, but I don't think it's a make or break deal, because it's we're just not in one of those super high cost areas right here.
And yet in property taxes, clients that I've had from California, here's the property. I always show them the property tax, what it's going to do, and it's never broken. No one's ever walked away from a deal because of the property taxes, even though some of them are pretty darn high, but from where they're coming from, they're reasonable, which it just depends on your viewpoint
and
around those
taxes.
Sales
tax down there. And
then but there's no sales tax here, and so you're going to make up for it in those kinds of things. You're absolutely right, and it doesn't deter anybody from doing that.
Nope.
It's just, something else they like is that you come here and you end up buying a house, and it doesn't automatically trigger a new tax rate. Because,
right. Yes.
We're not set up like that
and
down there.
And what Guy's talking about, Joe, is that when you sell a house, whatever that price is, that's the new real market value,
right,
on the property, which is also used for the assessed value in California.
Right.
And so people ask about that, and especially buyers ask about that, and they're just relieved that Oregon does not do that. We have our assessed value, which is the 3% creep that we complain about, but not. It doesn't change, because if you bought a house, all of a sudden, if you paid a whole bunch of money for it, the property tax is going to go hugely high.
Look at how properties have appreciated locally and everywhere. That would just
where does all that money go in California?
So we should just be quiet before they hear us in Salem, and all of a sudden it's on our doorstep.
Well, they tried to get it. People voted that down.
Yeah,
so they did try to do that in Oregon, and it was not successful. Because that would absolutely, I think that would devastate housing more than any particular thing that would do it to it.
Right? Yeah. That's all we need is a little bit more burden on.
What
the
rates, Guy? What we're talking today with Guy Giles from Bank 34 Mortgage today. What are rates like today? What are the ranges that you're quoting in all the different areas that we talk about whenever you come with us?
Well, they're a lot closer to the mid high fours now.
Mid to high fours.
It just depends. I mean, if you have a really good down payment and a good credit score, then we're kind of comparable with what they have going on right there on the front of People's Bank or something.
If I put a 20% down, which I had to do when I first bought my house, I had to buy 20% down. What rate is that going to get me compared if I'm only putting 3% down or 5% down? Does that change the rate?
It doesn't as much as you'd think, and I mean it can a little bit. But to be honest, you have that mortgage insurance if you have less than 20% down. So the bank is figuring that somebody else is using their own set of underwriting guidelines to look at that loan also, and then the bank doesn't have all that skin in the game. So the rates actually, you don't get hit as hard, and I've actually seen rates lower with 5% down than they are with 20% down.
Really?
And
okay.
Wow. And I know it sounds weird, and you don't want to go with 5% for the lower rate because then you have mortgage insurance, something that you do.
Right.
But it's not a bad option, especially if you have a decent credit score, and that's why I like to anybody that's got less than 20% down. I like to run our credit simulators. That's one thing that we do like to do to help people, because if you have somebody at a 730 credit score, that's a good credit score. If you can get them, say, hey, pay this thing down or do, something, and we might be able to get you to a 740, I might be able to get you an eighth lower in rate, which could translate to, a lot of money in time.
Over time, sure.
Yeah, I'm not a credit repair guy. I don't ever want to, come off like that, but we are pretty good at looking at credit reports. And if we can, maybe do a rapid rescore and get your score up a little bit, we've saved people a ton of money, just by taking a look rather than plugging them in.
The guy's experienced enough where he can look at a credit score and see the problem areas and say, these are the These are the areas that obviously
And also
the red flags are at.
what works to
and knows
rectify
how to
them
rectify
and mitigate
them.
those
Yeah.
as soon as possible. Yeah.
Yeah, because you really, I mean, credit is a big thing if you want to obviously purchase purchase property, which it should be. I mean, you should be able to show that you've got the wherewithal to pay it back, and you've got to do that, right?
Yeah, and I kind of like to talk to people even before they're ready to buy, because when you're ready to buy, then that's kind of difficult to guide people. We can again do the rapid rescore, and it's fast. But if you come to talk to me a couple months earlier, then we can take a look at your credit, and we can just kind of move you in that direction so that you're really ready when you find that house, or when you're going to actually pull the trigger and buy.
All right. What about the VA loans, USDA, FHA loans? Are you still getting those, or mostly still conventional that you're dealing with today?
It just kind of goes down to the credit score. Really, if I can put somebody into something that's kind of comparable and keep them out of an FHA loan, I will, mainly because that mortgage insurance just never goes away.
So the reason that if someone comes into you, Guy, is that conventional versus FHA, you actually want them, in your opinion, it's smarter for most people are smarter to look at conventional loan because of the mortgage insurance issue, correct?
Yeah, if I can get them in there. I mean, if you have a credit problem or something, then the mortgage insurance can get kind of cost prohibitive.
Yeah.
And mortgage insurance is something that you pay anytime you have less than 20% down.
Yeah.
And so,
yeah.
In a lot of instances, it is better to go conventional. I had some folks in there today that had a mid-high 600 score, and we decided to go conventional instead of the FHA that this other person had them in. We just did the math all the way down the road, and it is cheaper. If I can put somebody into a program one time and have it be just one loan rather than have to come back in 2 years to refinance, once they have equity, then they drop another $4,000 in closing costs to do it. So, and then who knows where the rates are at that point.
Yeah. If someone has, a loan right now, an FHA loan, and we have more equity in our properties than we did before, does anybody ever come in and does that ever go away? I mean, how does someone eliminate the mortgage insurance if I have a conventional loan? Does it automatically come out? But how does someone know whether I've got 80% equity? Yeah,
well, I mean, there's a couple ways. Legally now, they have to take it off once it gets down to 78%. So
how do they know what that 78% is? Well, where does that come from? How do you get it?
The original appraised value. So all they do is they have an amortization chart, and they say, you're paying down $230 a month, and then once you hit that, so they have automatic triggers that do that. The other way, when it appreciates like it is, after you've had it for a year or two, you can go in, and that's going to depend on your servicer on how you can get rid of that mortgage insurance. But you can generally go in, get an appraisal done on the house. They'd have to order it. Don't go order yourself an appraisal and then take it down to the bank and tell them, because they're not going to accept it.
It's not going to work.
But definitely talk to your servicer, because if you can go out that way and not have to pay for a whole refinance to get out of it. Right. That's usually a better way to do it. Another thing is if you come into a little bit of money, or you sell a house, or you do something, and you can usually re-amortize your loan also. You can make a principal reduction. So say grandma left me $50,000 and I want a lower payment on my house, but I don't want to have to refinance to do it. That would take 10% of that $50,000.
Right.
You can just go in, make a principal reduction payment. A lot of them, they want a minimum of $40,000. But it just kind of depends on, again, the servicer. But you can re-amortize that payment, and they'll redo it, and you'll actually get a lower payment instead of just taking years off the back of the loan. And you could potentially get rid of your mortgage insurance.
Interesting. There's lots of different ways, isn't that, out there that people can do? Well,
more and more people are going to be in a position to do that nowadays, too, with the equity they have.
Well, there's a lot of that right now. And so we're seeing that in terms of people, Guy, moving up and moving down. I've been so busy in terms of people moving down, right sizing, downsizing, whatever you want to call it. My goodness, it's that's just incredible, the numbers of us people who are doing this. And there's people that are ready to buy, but where do you go?
Wow.
That's the problem that we're facing in terms of housing. That's why we started talking a little bit about Ashland's and the new cottage ordinance that they have to allow for more age diversity. Changing everything. I mean, we're not the same. Our families are not the same. We don't need the type of housing that you grew up in and Guy grew up in and I did. We don't need that anymore, do we?
We think of Sharon and Howard Johnson and the aging in place homes that are kind of the new frontier of design with all the amenities and the wider hallways and doorways and things like that. You could do those on a smaller scale. And for our older community that's wanting to downsize, I could see, retirement communities of tinier, smaller homes.
Well, how many?
In fact, we should.
We're going to have it back. Investment. Yeah. The biggest thing is these are for housing for one. I think that's what a cottage housing is, a housing for one. Wow. And that's what we're going to see. I think that's going to be workers.
One and a dog. Yeah.
You got to have it.
Don't talk about it too much, or my wife will put one out in the backyard and stick me in it.
The tiny house.
Yes. Yeah. Well, she would do that.
Well, we've talked about how the alternative housing problem here in our valley, and this is an interesting solution to it.
I think you could do it with your zoning. I think you'd be good.
All right.
Don't tell her that.
I can't put up a barn, but I could probably do that.
We're talking with Guy Giles from Bank 34 Mortgage on the Real Estate Show today. Talking mortgage interest rates. Guy's got some new programs to share with us. We'll talk about those when the Real Estate Show rolls on here on KMED right after this. The Real Estate Show continues here on KMED this weekend. Pete Belcastro and Joe Brett, the Real Estate Guys, with you here this weekend. Yeah, my goodness, the end of February, heading into March. Basketball playoffs are underway. The Olympics are about done, I guess, aren't they now? And anyway, winter's here. We're having a good time. Real estate continues its merry way in Jackson and Josephine counties. The last stats, show just a lot of activity. 628 properties sold in Jackson County the last 3 months. Isn't that amazing? That's almost almost 30 more than the same period a year ago. In Josephine County, again, the same thing. There's just a lot of activity going on in terms of sales as well. Property value is increasing 8%. Josephine County, Jackson County in that period is 8.9%. So I guess as long as they're under double digits, I guess I can't complain too much about them. But that is the one kind of dark cloud on the horizon is values and how fast or quickly they may or they may not go up. Guy Giles is with us. He's the mortgage expert from Bank 34 Mortgage, joining us here today on the Real Estate Show. I'm always amazed at clients, lenders. You got to have the lender. It's 75% of all loans have a lender. That's a lot. The others are cash.
Well,
that's a lot. 75%, 3 out of every 4.
Yeah,
and there are millions of them. That's a lot of lending going on. Anyway, it's always good to have you with us. You have a program. We talk about ways that people can take advantage of rising prices. What can you do? What loans are out there that allow me to take advantage of some of these things? You've got one. I want to talk about a 3% down. Home Ready loan. Ready. What is that one?
Well, it's been around since 2005, so it's not necessarily
2005 or 15. You said?
Or 15.
15. Okay,
yeah,
it was 2005. That's a long time ago.
That's exactly as long as I've been around doing this, to be honest. But one thing you mentioned was Grants Pass, and you mentioned USDA earlier. It looks like they are looking at Grants Pass again to do away with the
USDA. Do away with USDA in the city area there.
Yeah. So it's one of those things that basically they have a $35,000 threshold, or 35,000 people threshold for that program. So we are obviously about 70 or 60 or 70,000 in Medford. So we've been out of it for a while, and basically because Central Point butts right up next to us, they get
added into it.
Yeah, and then there's a little bit of West Medford and a little bit of Central Point that'll fit, But out there, I think they're up to almost 38,000 people now.
Look, and Grants Pass is a booming place right now. Downtown, there's a ton of traffic, a lot of people there. So, I think Grants Pass, probably the urban area, no longer needs USDA in there.
Yeah,
it would be in the city area, not out in the burbs area outside the city.
Yeah, as far as that goes, it's great, to buy a place in town, but do be careful if you're going to use that program on a rural property, because they will appraise every building on that property, and I actually had one blow up one time because they gave value to a barn and then they took it away because they said that wasn't part of it. They could only do value on the house. So the overall barn actually was $8,000 or $10,000, and we hit our price, but they pulled that right off, and the USDA won't count the outbuildings. as far as the value goes. So if you give value to outbuildings under USDA, you could, it's kind of a
I've
weird
never
program.
understood USDA, which is rural development loan, and yet you have you're in a rural property in a rural building, and they won't count that at all, other than the house. That's always kind of odd to me, but it's a great program. It truly is, and
Yes.
and in fact, as our listeners know, USDA has the lowest default rate of any of the federal housing programs. And I think that just is a testament to people in rural communities and that they're solid people and they pay it back.
Yeah, that and they do have kind of the lowest debt to income ratios out there. That helps.
Yeah, they do have those. Yeah,
but you are right. It's a great program. There's probably a lot of places in the country. Unfortunately, they're just a little bit priced out there because of the maximum income limits.
So when
unless you have 5 kids.
And when we started our show in 2009, I think the lenders at that time, we didn't know you at the time. They were only almost, if it wasn't for USDA loans, Klamath, Josephine, Douglas counties, the coast, they wouldn't have had any sales.
No.
I mean, at one time, that's how big USDA saved so many, many, many people at one time. It's still a great program. Okay, back to the Home Ready program.
Yeah, it's kind of a flexible program. A lot of people think it's just for first-time home buyers, and that's a misnomer. If you sell your house, you are eligible to do another one of these. They do have some income limits, so it's basically 100% of the median income. So if I think it's around $53,000. Here was it? 50,
something like that. Yeah,
I'm sorry,
56,000 something.
All right.
Yeah,
53,600. Pardon me. So anyway, if you're 100% or under of that, I actually had a married couple where we just used the husband's income and didn't use the wife, so they were able to fit in underneath that. So it's not like the USDA where they just make you take in everybody in the whole family, but it's also got some other nice things. So if you do have border income, say your brother's been paying you rent for a year or so, and you want to use that for a little bit of extra income for the house, they will accept some border income. If you have an additional dwelling unit on the property, they'll allow you to get income from that right away, which is nice. If you buy a 2-unit property, you have to come in with a little bit more down payment as you get to more units. So I think I'll probably stick to the single family piece of this thing, but it's just. It's one that, there's a big strip of land over by the freeway that there are no income limits on at all. So if you were down all the way over to Spring Street from the freeway in East Medford and then down, there's just a ton of blocks down there around part of Medford that actually do fit into this. So if somebody has a listing in that area, they can call me and I'll look it up and see if it's in that area.
Okay. All right.
So
and people take advantage of this 3% down. Right.
Yeah, and you don't have to have any skin in the game if you're buying the 1-unit property. So mom or dad could come in and do that, and they can actually. There's a term that hasn't been around for a long time, but it's kind of like a non-borrowing, a co-borrower that's not going to be living there basically.
Okay,
So there are a lot of different ways that you can get into a house and have family help you. If somebody's been paying your student loans for a year. Then you don't have to get hit with that if mom or dad's been helping you out with something like that. So I don't know. It's worth just at least having the conversation.
It's like it seems like that's a good alternative, for some people who need that. When you said that you could, there's a number of loan limits. You have income limits on a number of loans. You said that, say, if you're husband and wife and you have 2 incomes, you said. This your Home Ready loan allow you just to use 1 income, right?
Yes,
even though you have 2 incomes coming in, right?
Yeah. I mean, now that doesn't mean. I mean, we literally did not have the wife on the loan, so that's how
right.
That worked
she's
out.
not on the loan at all, right?
But it is legitimate to do it that way, which it's not under USDA. If grandma's living there and she has income, even if she's not contributing to anything, you have to use that income, and that can put you over a lot of times.
Yeah.
But like I said, it's worth plugging in an address because there are some ones that go all the way over to Spring Street, which was quite a lot of East Medford, and so it's just kind of a strip along the freeway that fits into this. So I don't know. I've done a few of them last year, and it's kind of nice.
Well, it'd be good for some people. Now, one of the problems that I've had with different clients revolves around self-employment. So many of us, I mean, all real estate brokers, or all independent people, and independent business people, self-employed. And it's so difficult, it seems sometimes. I've had many people just kind of been turned down because they're self-employed, they make money, but they don't show a lot of money being made. And so it's difficult for them to get a loan.
Yeah. And
okay.
This is kind of how the whole stated loan thing started out.
We got a break coming up here in a second, so I just want to know.
Anyway,
we're going to talk about this mostly after the break, though. But that's an interesting scenario for people, isn't it? I mean, think about that way. You're self-employed. What do? You're just kind of messed up, aren't you?
Yeah, either you're paying way too much in taxes, or you're showing enough to be able to buy a house. So it's one of those fine lines.
Guy, it's like I've sold a number of businesses in the Valley, small businesses, and when the seller comes, the first thing they look at, they want all this money. Well, are you showing it? Are you making any money? Well, I use it for this, and this for my own purposes. I don't show a lot of money. Well, that doesn't help you when you want to sell it, as you well know. People want to make money. You got to be there. And we'll talk about self-employment and how you get loans with that with Guy Giles from Bank 34 Mortgage on the Real Estate Show. And we continue here on KMED right after this. The Real Estate Show rolls on KMED this weekend. Pete Belcastro with you here. Joe's got to take off a little bit early today, but we'll be back next week. Speaking of next week's show, it takes jobs to have an economy going. And we all know how the real estate market industry itself is such a driver of jobs, a lot of jobs, a lot there. So Ready, Southern Oregon Regional Economic Development will be with us next week, and we'll get an update on what they've been doing in terms of bringing jobs into the Rogue Valley. And Colleen Padilla is executive director there, and we'll get her take on this. They're quite busy. I attended their recent event in Medford, and there's a lot of activity going on in the job world. We'll update you that because you can't have a real estate market unless you have jobs and money to spend, and that's So Ready's job, and we'll get more of that next week. Today, we're with Guy Giles from Bank 34 Mortgage. He's our resident mortgage expert on the Real Estate Show, and well, here we are. My goodness, next time it'll be March, which begins March, April, and May. So usually the three busiest real estate months of the year. It'll be interesting if that holds true this year or not. But Guy, before the break, we were talking about if you're self-employed, trying to get a loan sometime, for business or your own personal property, seems to be such an issue for so many people. Now, you've got something here called the bank statement, right? The bank statement loan? Is that what that is? Tell us what that is.
Yeah, they've been around for a little while, but, pretty much just if you have your gross receipts, you have money coming into your bank, they know that you're actually making a good living, but you don't necessarily show it on your taxes.
Yeah.
You're not going to get the very lowest rate out there, but they're still not bad. So if you look at the overall picture, not being able to get into a house as opposed to being able to get into a house. And actually on the next show, I'm going to talk a lot about not being in your own house and how much you actually pay in rent versus if you were to buy a house, even with the rate a little bit higher. So that they're not terrible, but like I said, for somebody that's completely shut out of the market, it's not a bad deal. So they'll just kind of take a look at your, receipts or, for the last year and just make sure that's going okay. And they probably will.
Is it only 1 year for self-employment, or do you have to have? I heard you have to have like 3 or 4 or 5 years worth of records. Is that? Well, that's not true then.
And you're not turning in any tax returns or anything on this. They're just kind of looking at your bank statements for the last.
At your bank statement.
Yeah. So it's kind of a nice thing.
I mean, self-employed people like I am. Money comes through all the time and in and out, so they're looking at bank statements, not necessarily that tax document, which shows me basically making very little money or something like that.
Right, and they will back it up with probably a note from your CPA or something, saying that this isn't like completely legit, that they're destitute at the end of the month. But so they're doing enough to they're still looking at your credit, they're still looking at things like that, but really they're going to base your income off of your gross receipts and then what's really going out, not necessarily what.
I don't know. I don't know what the percent is. I'd love to know it if we could ever if somebody could figure that out in our local counties regarding how many people self-employed are involved with getting loans, receiving loans, and how that works for them, because there's so many thousands of people who are self-employed, and more coming.
Yeah, and this is actually what this is how the whole thing got started when we got into trouble before. But I don't think they're not really approaching it the same way. In the old days, they had stated loans for people that were self-employed that just didn't show it on taxes. They knew they were credit worthy. They didn't have a lot of debt. They didn't have, a bunch of issues. They know that they're self-employed and they don't show it on their taxes. So they came up with the stated loan. It was when they opened it up to everybody, the waitress, the anybody, as long as you had a 680 credit score, they would give you a stated loan. So you could just say, I'm a plumber or I'm a garbage man and I'm making $400,000 a year. And when they opened it up, so I don't think it's going to get reckless like it did before, but it is what the whole thing was intended for to begin with, until everybody started just opening it up a little bit too much.
Well, you got to be careful there, obviously, on that.
Yeah.
So I'm glad it's not the wild thing going. That's the one thing, that over the years, as we talked lending at different times, is are these programs, are we going back to the way it was when before the big crash? And it doesn't sound like it.
No,
it doesn't sound like it.
No, it does feel like they're loosening up things a little bit. We mentioned a couple weeks ago that they're coming out with higher debt to income ratios that are auto approving, from Fannie Mae and Freddie Mac. And, some of the mortgage companies or the mortgage insurance companies have pushed back on that a little bit and said that if you have the lender paid mortgage insurance, if your debt to income is over 45%, they won't necessarily underwrite it. So that's something to be really careful with your lender if you're going to get into that situation. They're not doing it now on the regular monthly mortgage insurance that you pay, but they are doing it on the lender paid one. So they're kind of not going along the Fannie Mae Freddie Mac lines on that. So, it's ever changing. They're trying to loosen up and let people be able to buy without.
Now, before we get out of here, I know one of the things you wanted to talk about briefly was, we have higher interest rates slowly kind of creeping a little bit up. We certainly have. We saw an 8.9% median price increase in Jackson County, 8% Josephine County. Buying today versus the end of this year, it really, as it goes, the value is to tie it up now. Tell me what that means.
Yeah, and I'll probably need to allow a little bit more time on the next show to really talk about that. But I did do just a little bit of math as far as a $250,000 house. If you put 20% down, the difference in a 4% rate and a 4.5% rate, so half a point is a pretty good jump in rate, but you're literally only talking, you're less than $2 a day. I know that, it can be
payment.
And so
should people keep their cash? I've always taught, I've taught people, I want to keep as much cash as I can. Sometimes,
I've been doing a bunch of math both ways on that, on investing versus, the real estate market.
Yeah.
But I'll tell you what, even if you're paying a little bit more in rate, it does amount to about $21,000 more over the life of the loan. But you got to figure your $250,000 at the end of that life of that loan. If things only went up at 4%, you have an $810,000. And I did do a little bit of math for the last 19 years around here, and it kind of appreciated, at least on one of my houses, at 4.8%. So
was the
even
average
lower? Yeah. So even lower than that, you might lose a little bit in rate by going 0.5%. But what you're going to gain in your house is just, it's amazing.
Yeah,
and like I said, I'll go into a lot deeper into that. But even if you go up a full percentage point between 4% and 5%, you're looking at like $26 a week.
Right, and you can do that with more down, correct?
Yes.
More money down to get you that kind of a deal. Yeah.
Well, yeah. There's a lot of different ways.
Yeah, I was going to say
look at it, but
the best thing is to get a hold of Guy at guy.g, right? At bank34.com is his email address. You can Google him too because he comes up there. And the best thing is to go talk with Guy about these different programs because you've got something that fits individually. They're not one size fit all when it comes to lending. Boy, we've certainly learned that. You do have to shop around, and if you do, you come up with some really good programs like you've shared today.
There's a lot of stuff.
All right.
Thanks,
well, look, my friend, we'll talk to you soon. We'll see you next month back here on the Real Estate Show. That'll do it today here at KMED. For Pete and Joe, have a great week, everybody. Check out the website, realestateshowOregon.com. We will see you next weekend. Have a great week. God bless you all. We'll see you next Sunday.
You've been listening to the Real Estate Show on KMED Radio, presented by the Rogue Valley Association of Realtors, along with John L. Scott Real Estate of Southern Oregon and Bank 34 Mortgage. For guest contact information, download our free app or or to watch a past show, visit us online at realestateshowOregon.com. This show is produced by Table Rock Productions. Join us again next weekend for Southern Oregon's one and only real estate show on KMED. And thank you for making the Real Estate Show part of your weekend.